All right, guys, new CMHC changes are here. Ehren and I are going to break down everything you need to know about what is happening and how it's going to affect you.
Some very important guidelines, so make sure you watch to the end. Hey guys, Ehren and Josh here with another Finance Friday. Today we want to touch on the CMHC changes that just came out on June 4th. A lot of big updates here looking at use of funds, the energy efficiency program, and some changes to the standard program along with new construction.
Yeah, if you guys feel like CMHC changes their policies more than you change your underwear, it's probably right. Now, it seems to be that every few months they seem to be changing the rules. So today's video, we want to discuss in depth how these changes are going to affect you, the market, your strategy, your development, what you can do to plan for it, and why maybe some of these things are going to work for us and why maybe some of these things aren't going to work for us. So let's dive in. First things first, the guidance around 2-year refinancing, NHA approved debt, private debt, VTBs, big news coming out. I feel like that CMHC can take a little, but they're also giving a little back.
Yeah, it's going to probably annoy a lot of you guys that just went through a refinance and did not have an NHA approved lender on board, and were either declined, like I know a few of my clients were, or had to go into a bridge route and unfortunately had to pay some additional fees. So as upsetting as it is, looking forward, it is a good change. So as of June 4th, CMHC will now take out any sort of private lender, non-NHA approved lender on title without there being an NHA approved lender on title for 24 months. So, VTBs, non-NHA approved, NHA approved, not on title for 24 months. Basically anybody not on title for 24 months. So this is great. I mean, it's going to allow for, better expediency in between projects. You're not going to have to worry about holding on to interest only bridge debt at, 9.5, 9.75, 10%. Which was really just crushing the middle level investor. It's tough enough already to do a project for 12 to 18 months and have to be in the red, but then to potentially have to hold on to that for another 6 or another 12 months, depending on the timeline. It just wasn't working, and it didn't make any sense when you could essentially just turn around and sell that building, and CMHC would go ahead and fund it anyway. So glad to see that change. That's going to be huge, and they're also just opening up your use of funds. So in, I think it was 2021 or 2020, CMHC put out a policy where they limited what you could do with equity takeouts from CMHC refinances. You had to build, buy, or renovate a multifamily building. Now you can take that money and put that towards anything you want, which is going to be great for a lot of investors because we know over the last few years, just with a lack of liquidity, it's been tight. There's been a lot of private funds being put to use in the projects, and it's been tricky to have to pay out these investors. You either had to go the bridge route and take a lower loan to value, not get all of your capital out, and try to pay back as much as you could, or hopefully none of you guys were taking CMHC proceeds and paying out your investors, but those were really your only options, right? So now complete freedom with use of funds, and that's going to give a lot more flexibility.
Yeah, I mean, I feel like we've been jumping over hoops for the last 2-3 years just around trying to figure out NHA approved debt, paying people back. This opens things up immensely. These are probably some of the largest challenges our clients were facing when trying to stabilize a building and move it into CMHC debt. So really they're taking down a handful of hurdles right now to allow you guys to get into CMHC after your project is actually done, which is great to see. I mean, they're listening to people and lobbyists and opening up the restrictions to allow the investors to actually move capital and purchase additional property. Right now we're in a very interesting time where the majority of legacy sellers have the ability to provide VTBs, and for the last little bit you haven't been able to really capitalize on that. So this change is going to allow newer investors or investors who are looking to take on maybe and negotiate better terms on these larger to mid-sized projects. This is going to open up a whole other level of financing to allow you to be able to get in, maybe take a longer, better term option than what is out in the private market, and then stabilize and move it into CMHC without really worrying. All right, let's jump into the energy efficiency guidelines with CMHC. So if anybody has been using the MLI product since its inception, the energy efficiency kind of loophole has been used in Ontario almost unanimously. Most people only focus on creating their points through energy efficiency. And for anybody who doesn't know how this works, You get a baseline on your pre-existing building and you increase the efficiency of the building by a certain percentage to be able to achieve your points. Now, if you increase the efficiency by 40%, you're able to achieve 100 points. I think they realized that every investor in Ontario was doing that and nobody was focusing on creating affordable units in Ontario. So they've actually changed the product fundamentally and will only allow you to have up to 50 points for level 3. So what that means is you still have to do all the work and spend all the money, but you're only going to be able to achieve 50 points, which gives you a maximum loan to value of 85% loan to value and 40-year amortization. If you're looking for that increased amortization or loan to value option, you're going to have to achieve your points in another way, whether that's having actual true affordable units in your property or having some accessible units available to you.
Yeah, so it hasn't killed the energy efficiency, but it's definitely going to make it more complicated and probably annoy a lot of mid-sized investors out there who, again, investing in the Ontario market, it's just almost impossible to be able to make the affordability work in any major market. Secondary markets, there's a little bit more room, but in any major city, the affordability just really doesn't. It's affordable for the tenant, but it's not affordable when taking a look at it from the developer investor side. So unfortunately, those are some changes that have come down the pipeline. I think it's really going to push people getting into some of these smaller new developments that we're taking a look at on these infill with use of right up to 4 units on a lot now. Being able to get in there, classify that as a new build, much more easier to obtain the affordability when you only have to take a look at 10% of your units in combination with MLI Select will get you at least 70 points. So getting you into that 85, 45-year amortization makes it a lot more affordable than taking a look at like repositioning other projects where your minimum point structure starts at 40% of your units having to be affordable. And given the market data that we're using for median renter income, again in these major areas, it's pretty tough. So taking advantage of those new builds and those much more lenient requirements, I think is going to really push people in that direction.
Yeah, and I mean, I think it's going to also allow people to start viably taking a look at standard financing options again. I think that maybe was the reason why CMHC is also making this push, is they want to move people back to the standard product. I mean, tinfoil hat kind of situation. They are a for-profit company and they do make higher premiums on the standard product. The majority of their applications did go to the MLI product. Now, keep in mind for new build construction, I saw a post the other day and it outlined that this is going to stop all new construction, starts. This isn't going to stop new construction starts. The standard product can actually provide up to 100% loan to cost. And with these new changes we're going to get into, they can provide a 50-year amortization on new construction projects. You might have a slight higher premium, but realistically, I don't think this change with the MLI product is fundamentally going to change new housing starts. It may obviously cause you to not have maximum leverage on pre-existing buildings anymore, or you might actually have to, unfortunately, create affordable units.
Yeah, so if we take a look at the new breakdown for points on the energy efficiency pillar, level 1 gets you 20 points, level 2 gets you 35, and a level 3 gets you 50. So as Josh mentioned, even if you go through and you put all the work in, you're still mainly going to get 50 points, which really does just put you in the level 1 qualification sector for the MLI Select point structuring overall. So again, you're going to have to take a look at bundling it up with another pillar. I think there's still going to be a lot of leverage put on the energy efficiency and then just trying to bundle in a small amount of affordability, or if you're doing brand new build, maybe adding in the accessibility and just trying to scrape out with level 2. I don't think it's a bad thing if we keep the leverage at 85% loan to value and sitting up to 95% loan to value. Again, I mean, I understand the need for a lot of investors to get the capital out these days, but when you take a look at the leverage and how it actually pans out when we take into consideration the insurance premium, you might be qualifying at 1.1, but once you add that insurance premium in, you're somewhere between 1 and 105. You're really not making a whole lot of net cash flow on these buildings. So again, not a bad thing if investors start taking a slightly lower leverage, but we'll see how that plays out.
I completely agree. I think, I was golfing the other day and I was talking to a well-known investor and I said, do you remember the days when an investment was an investment, when you didn't get 100% of your capital back? Those are the days that that obviously should be back into the market when we have a healthy market. So I think the lower leverage is probably the best way to go in this situation. And if you're in a new construction project, you get 95% loan to cost, whether you get 50 points or whether you get 100 points. So your actual total equity takeout on a new construction project isn't even changed. It's just the amortization that you're going to have to toggle with depending on how much capital you want to spend. It's going to be interesting to see how many people actually choose to spend the capital on the renovations for the energy efficiency upgrades, other than just paying the additional premium on standard and getting the same amortization and same loan to value options. I do see a lot of people maybe moving away because the cost of it is a true out-of-pocket cost, whereas the cost of the insurance premium isn't a true out-of-pocket cost. They don't actually have to pay it, so they don't have to do the work to get the energy efficiency upgrades. I probably see it split down the middle, where a lot of people do end up going to the standard financing option side.
Yeah, I mean, and I think it's also going to push, even more people probably into the Alberta market as well too, where you can still do affordable and still have a net surplus on your leases. So going to go a few different ways, but again, it's at the end of the day, CMHC is really just sticking to their mandate of affordable housing and new units. Obviously, if we had left the energy efficiency the way and just allowed investors to continue to build new units, we would probably organically get to a more affordable market, but I just don't think it's moving the ticker as fast as what they're looking to do on their timeline. So
completely agree. Moving on to the next change, we already kind of touched on it. CMHC is going to allow up to 50-year amortization now for all new construction starts. So if you are getting CMHC construction financing, we can now run your debt servicing coverage ratios on a 50-year am, which will help most developers at least recoup some of the invested capital that's in these larger projects, because currently right now a lot of these bigger projects aren't penciling.
Yeah, and that's with standard CMHC. So unfortunately, you can't just do a new build and do energy efficiency and still get that 50-year AM. I think CMHC is done creating loophole type policies. So yeah, standard new build 50-year AMs, which is going to be great. Obviously, that's going to help. If you're taking a look at offsetting that, MLI Select underwriting at 1.1 with the 50-year AM versus, the CMHC standard at 1.2 with the 50-year AM, I think it's going to be a pretty nice kind of happy medium to be able to get there. Obviously, I don't think you're going to get quite the same level of affordability just with the additional debt servicing, but again, not a horrible option to take, a 10-year term at 1.2. Obviously, if you're looking to get, more shorter term with CMHC, 5-year at 1.3, it's not going to be as effective. The extra 10 years is still going to help, but it's not going to be quite as effective. So, whether or not we see a switch to a lot of investors going on that 10-year route just to be able to squeeze out the affordability, I can see that being a popular option.
I think that might be by design too. The CMHC definitely wants for people to take on more long-term debt options as well to be able to stabilize out their portfolio. So, I agree with that. I think that if you're taking shorter terms, most people are going to lean the MLI side. If you're going to take the longer term, that standard side without having to spend the additional capital is probably where most developers or people are going to be going.
Continue the amortizations. On the MLI Select side, they're actually looking to increase your max amortization to a 55-year AM. Still waiting on some policy wording and updates, but they have announced that change will be coming. So just stay tuned for that. And as we hear from CMHC, we'll obviously release that news, but that is coming. So something to kind of look forward to, I guess, in terms of all the other not so much things to look forward to. So,
well, some interesting stuff to look forward to is CMHC has had a pretty staunch mandate on we do not fund anything that's ever been contaminated. CMHC is actually allowing developers to find opportunity in this land, maybe to actually get some financing on it.
Yeah, so this change takes a look at their current policy, which states that basically for COI, you have to have a clean environmental. If you don't have a clean environmental, CMHC is just not going to fund the project. This is basically allowing developers to go into CMHC, obtain the COI, possibly even allow you to close on the transaction as long as you get the remediation on the land done within 6 months of that COI and prior to the first advance out of that construction tranche. So again, it's just giving developers a little bit more flexibility and a little bit more expediency on their projects instead of having to first sit and wait, get the land remediated, then go ahead and apply, get the COI, then go and shop it to the lenders. Now you can start the process and get everything going and just have it put together more smoothly as you move towards. And hopefully it shaves a few months off some of these timelines. Now, I don't think it's going to change anything drastically, but I think it's definitely a nice change, and it's going to help just make things a little bit easier on the development side.
Yeah, you can probably see that there's a bunch of land in like major populated areas that are just kind of sitting there idle at the moment, and the federal government with their new mandates around increasing density, is going to allow some of these developers to start moving on these projects and making them more appetizing, for making high res development in these large areas.
Yeah, this is really going to apply to raw land. I mean, any sort of infill project, like 99% of the time, is already going to have a clean environmental. So there really isn't going to be very many issues there. In terms of like how CMHC looks at that, in terms of whether or not they're going to include remediation in your construction budget, they will not allow the cost of remediation in the budget, but they will allow the increase in land value to be considered in the construction cost. So again, they're not going to finance the remediation, but they will allow for that increase in land when taking a look at your overall cost.
Yeah, so if you're a developer and you're looking for opportunity, this might be a great way to be able to use CMHC development financing while getting a great price on the actual land itself.
Another policy change that's coming down the pipeline is classification as to what is considered new construction. First things first, obviously, brand new raw land, ground up construction, considered new construction, no worries there. The confusion and the issues were coming on to infill projects where you would go in, you knock down a building, or maybe you're adding units to an existing building, and some of the CMHC underwriters were either classifying this as new construction, or some of them were not classifying this as new construction. I know, talking to both the lenders and the investors, some individuals were having success and some individuals were not having success. So new flexibility, new clarification coming out. When you're taking a look at the wording from CMHC, new construction, obviously brand new units, or taking a look at residential buildings that have been fully vacant for 12 months. So if you have a fully vacant building, it's been sitting vacant for 12 months, and you go in and do the renovations, CMHC will consider this new construction. Also taking a look at full conversion projects as well too, which was already previously clarified on. We know going from office or like hotel motel to residential buildings, this was considered complete change of use. They were classifying that as a new construction project. And then obviously on the tear down, so the building has to be completely torn down. So obviously tearing down the building, brand new construction, that's going to be classified as new construction. So just some further clarification on that situation, just to make things a little bit more clear. It's going to be accepted across the board now. If you are doing infill and tearing down that building, should be no issues at all moving forwards.
Interesting, because we get these questions all the time with these new infill projects, like what is, what isn't. Really important classification, because if you're using the MLI product and you're trying to go energy efficiency, you have a pre-existing piece of the house, you want to build off of it. At least they created some clarity as to, no, you can't do that anymore. But this is where, at least you and I have had many conversations about it, where we think this is going. Those infill, brand new to 10 and under developments in decent areas. So, creating clarification around these types of policies and paving the way for investors and developers to continue to use these products, I think was really important, because there's just a ton of questions around there about how do I do this? What are you going to classify it as? Because there's nothing worse than planning a project and then having an underwriter come back and say that wasn't what was guidelined out. So
yeah, and I think that's one of the biggest issues that they're trying to clear up here was, and we always say it to investors, but it depends on the CMHC underwriter and how they pick up the file and how they translate it. You can kind of use that across a few things previously, at least when it came down to the lenders on title and were they paying out construction or renovation, or were they not paying out, that whole situation. So again, I think this just clears up that, depending on the underwriter and depending on the underwriter's interpretation, they're just kind of making it clean cut. When it comes down to the actual demolition cost of tearing down the building, CMHC is not allowing that to be included in your construction budget. So again, just similar to the remediating land, they're not taking that into consideration when looking at the construction budget.
Yeah, guys, so last but not least, the last piece of guidance that CMHC is coming out with is kind of a bittersweet situation. They are getting rid of the CMHC Correspondent status. Essentially what that means is there were individuals like our brokerage, we were able to go directly to CMHC, submit the file, and then you would take this certificate of insurance and you could shop the debt around. You could take it to any different type of lender and try to get the most competitive rates. Well, unfortunately, that's no longer available. CMHC, as of the start of September, is going to be stopping that program, and all applications are going to have to be directed through CMHC approved lender. So, your broker's relationships with the lenders that they have is going to be more important than ever for getting projects done, for being able to expedite things, get clarity on situations. It is an unfortunate situation, but it felt like there was a ton of correspondence, and I think what CMHC is trying to do is increase the quality of the applications going through them, and maybe reducing the amount of ways in which people can submit files so they can keep track of the on routes essentially into CMHC in their application process.
Yeah, they are still accepting correspondent submitted applications up until the 3rd of September. So if you have files and you are looking for support, we can still help and assist with those, help to get better pricing, but it does end as of the 3rd, or 3rd of September at least. So, if you have these applications, in my experience, in my thought, I think as we get closer to that September deadline, the tap's going to get, slowly shut off. So, if you're looking to get those deals in through a broker and get a little more competitive pricing, I would say get those in now rather than waiting closer to September, just to avoid any, obviously delay of applications getting in and, potentially not getting in before the cutoff timeline.
This really isn't good for the average investor, though. I mean, unfortunately, it requires you to find a lender and stick with that lender. You can't shop your options. You can't find the best rates. You're going to obviously have to deal with your broker. Your broker's going to have relationships with those lenders to be able to give you the best terms. But if anyone's done this before, you have to get a letter of intent. You put a deposit down. And usually once you put that deposit down, you have your broker, you have internal staff, you have the lender staff. Everybody's working on it. You have legal teams involved. Capital is being spent on moving the process forward. So, it's going to be very tricky to be able to, if you wanted to go to multiple options or multiple lenders, because there's quite a bit of capital involved for good faith deposits on something like that. So probably not the best move from an investor side or from the client side, but from a quality side, I can see why CMHC is moving that direction.
Yeah, I mean, I'm hoping it's pretty similar to the 24-month policy where, they're just kind of using this as an interim to figure out a better way to monitor the broker submission process and the broker correspondence process. I think it's a tough blow to the broker network, and I think it's valuable to have these brokers out there that are able to get these things done and be able to actually help their clients. So hopefully maybe in another 6 months, 8 months, we'll have another policy change come out after they've kind of figured some stuff out. But tough to say, but I think, overall, I think having the support of the broker community, is imperative to strong success in the commercial market.
For sure. A few ending notes for the CMHC MLI submission for the energy points. If you have already submitted the file into CMHC, your file will be grandfathered in to the 100 points. So as long as you get it in before the cutoff date, you're good. Keep that in mind that a lot like when we had a cutoff date previously, we're most likely going to have a ton of files, and the processing time from when you submit until when you're expecting it is going to take quite a bit of time again. We've already seen it in the last 2 days since this information came out, so just keep in mind that it might take a little longer than it usually has. And forward-looking guidance, I think a lot of this stuff is good for the investor community. I think that the taking loopholes away, is going to allow for less leverage. It's going to allow for people to be able to not have to jump through hoops to do really expensive bridge financing. It allows, honestly, the smaller developer, smaller investor to not have to burn a lot of capital once your project is complete. So, all in all, you take a little, you get a little. I think that these decisions were moving in the right direction, and if we're going off CMHC's policies, we do need to create more affordable units, and this is how they're going to do it.
Yeah. June cutoff for the MLI Select, June 19th. So if you have those files, make sure you get them in. Like Josh said, there's going to be a huge surplus, especially considering all these other applicants that just got denied due to non-NHA lenders are also going to be coming at the same time. So we're going to have an influx of your energy efficiency and just an influx of guys looking to get other private debt. So if you have those files, make sure you get them in ASAP.
If you guys enjoyed this video, we would really appreciate you hit the subscribe button, hit the like button. Allows us to create more content like this for you guys. If you did like this or you want us to shoot anything else, please outline it in the description below or in the comments below. It'd be great. Really appreciate you guys. See you next time.